Um, okay,
Okay.
here you go.
All right. Okay. Good afternoon, ladies and gentlemen. Thank you for your time today to join this meeting at this hour. I call this meeting into order. As we are aware that our agenda today is focused and critical on our objectives. Where does our capital work first? We specifically, we have been given task on evaluating and comparing the financial performance for the two key players in this watch list today, the Public Bank Berhad and the RHB Bank Berhad. Today, I just want to focus on the key metrics, specifically the profitability ratio, the liquidity ratio, and the strength and risk, to ensure that if Public Bank premium valuation is still justified or RHB Bank does actually provide a more competitive price levels. So I do encourage an open discussion within to look at the data to ensure that our final decision will be aligned with our agenda and our objective today. With that, I will hand over the stage to the presenter. Please proceed.
All right, thank you, Chairman. So, a very good afternoon to everyone. Today, I will briefly share about insight from a profitability comparison between Public Bank and RHB Bank based on their past 2-year annual report, which is to 2023 and 2024. So, I will mainly focus in 5 key indicators, which are ROE, ROA, ROCE, operating profit margin, and net profit margins. First, we look at ROE, which is return on equity. ROE tells us how effectively a bank uses shareholders' funds to generate profits. So, after my analysis, according to the table that shown here, the Public Bank consistently records an ROE of above 30%, where RHB Banks is around 10%. So this indicates the Public Banks delivers higher returns to shareholders, making it more attractive from an equity investor perspective. Next, the ROA, which is returns on assets. ROA actually measures how efficiently total assets are used to generate earnings. So here we can see that Public Bank achieved a strong ROA of around 1.7%, which is well above in the industry average, but the RHB banks is closer to 1.1% in ROA. So this showing lower asset efficiency. From the profitability perspective, the Public banks clearly manage its assets more effectiveness than the RHB banks. And thirdly, return on capital employers, which is ROC. In banking, this is often assessed through returns on risk-weighted assets. So Public Bank have maintained a return of around 2.6%, and supported by the strong capital disciplines and low impaired loans. But for the RHB banks, it's comparatively lower compared to the Public Bank. So it's reflecting higher credit risks and weaker cost efficiency. We're now moving to the operating profit margins. These ratios actually highlight how well a bank controls its operating costs. So in Public banks, it has records and operating margins of over 65%, driven by the lowest cost to income ratios in the Malaysian banking sectors. But for the RHB banks, the operating margin is below 50%. So this indicating higher operating expenses for RHB banks. This shows that Public Bank has a clear structural efficiency advantage. Finally, we come to the net profit margins. The Public banks converts about half of its revenue into net profit, which with margins around 55%. But for RHB banks, net profit margin is in the middle to high 30% range. This reflecting weaker earning conversions. So higher margins also means to Public banks is a better position to stand with economic downturns. So in conclusions, in my perspective as a profitability analyst, so I think that Public banks have a more outperforms than RHB bank across all these key metrics. So Public Bank demonstrates strong efficiency, superior margins, and consistent returns, making it the better investment choice for long terms. That's all for me. So we'll move to the next one. Thank you.
All right, thanks, Shirley. So we'll be talking about liquidity and also asset ratios for my part, mainly on this on these 4 points. So next slide. Just a bit of context for everyone so that we all get and understand this. We're focusing on how liquidity and efficiency ratio because it's explaining on a bank's ability to operate sustainability. Liquidity ratios assess short-term solvency and stability, while efficiency ratios evaluate how effectively assets are utilized to generate income. So we're using Public Bank and RHB here for our discussion. And this analysis highlights the trade-off banks face between maintaining financial stability and achieving operational efficiency. Liquidity measures banks' capacity to meet short-term obligations, such as deposit withdrawals and interbank settlements. So for banks, liquidity is not optional. It is essential for survival. Insufficient liquidity can quickly erode depositor confidence and also disrupts their daily operations. So therefore, effective liquidity management ensures continuity, resilience during stress periods, and overall financial stability. Let's look into the table. Okay, so when comparing liquidity, Public Bank adopts a balanced approach by actively deploying deposits into loans while maintaining sufficient liquid reserves. This supports income generation but requires discipline in liquidity control. In contrast, RHB Bank follows a more conservative liquidity strategy, holding stronger liquidity buffers and maintaining a lower loan-to-deposit ratio. This enhances stability but limits aggressive growth. The key difference lies in Public Bank's optimization of liquidity versus RHB's prioritization of safety. So that's talking about asset. From an efficiency perspective, Public Bank demonstrates higher asset and receivable turnovers, indicating more effective utilization of assets and faster recycling loans into income-generating activities. This reflects strong operational discipline and credit management. RHB, while more conservative, shows lower turnover and higher levels of low-yield assets. As a result, Public Bank achieves higher efficiency, while RHB Bank trades efficiency for lower risk exposure. So in conclusion, next slide. In conclusion, liquidity and efficiency ratio together provide a comprehensive view of bank performance. Liquidity ensures stability and continuity, while efficiency determines how well assets generate returns. Public Bank demonstrates stronger asset utilization, while controlled liquidity risk, whereas RHB Bank emphasizes stability through conservative liquid management. So ultimately, sustainable banking performance depends on achieving an optimal balance between financial safety and operational efficiency. Pass on to Bryan.
Yep, thank you, Zoe. So good afternoon, Chairman. So I will be assessing for the risk from 4 aspects for Public Bank and RHB Bank. So from credit risk, capital and solvency, funding and liquidity risk, and as well as the market and concentration risk. So we start at GIL, which is gross impact loans. So this is the credit ratio used by the bank, which means the borrowers have the difficulties in paying the loans. So as shown in my table, for financial year 2023 and 2024, Public Bank have the amount of 0.959% and 0.52% respectively, while RHB Bank have 1.47% and 1.74%, and 1.47% in financial year 2023 and 2024, respectively. So in this comment, Public Bank have the better gross impact loans compared to RHB Bank. Next, we go for the loan loss coverage. this is indicate how well banks have set aside the money to cover the bad loans. So from my table, we can show that in public bank has actually more than 100% of the deposit money to actually prepare for the bad loans. Our RHB Bank only shows 78.6% in financial year 2024. So in this LLC or loan loss coverage, Public Bank will be performing better compared to RHB Bank. Next, we go to the credit cost. So credit cost actually estimate how much the bank spend on the loan losses. So the lower will be the better lah. So it's actually based on the best basis points. So for public bank, there is nearly 0 basis points for in financial year 2023 and 2024. Or RHB Bank have the average of 20 to 25 basis points in financial year 2023 and 2024, which means public bank have the better credit cost compared to RHB Bank. Next will be the capital and solvency. So the critical measure will be the common equity tier 1 ratio. So this is the most important measure to ensure the bank financial strength and solvency. So they also estimate how high quality capitals of the bank to compare with the risk-weighted assets. The higher will be better lah. So in this table, it shows that public bank have around 14 to 14.5 for both year. Our RHB Bank is stand around 16.4% in 2023 and 2024, which is RHB Bank have the better capitals and solvency compared to public bank. Next will be the loan to deposit ratio or LD ratio. So this is the ratio, how is the aggressiveness of the bank workouts compared to the deposit received from the consumer. So the LDR, the higher the LDR, the higher the risk lah. Public bank have the higher risk to RHB Bank with the surplus of 2% in 2024 and around 6% in 2023, higher than RHB Bank. We stand from 97.9% to 95.3%, as well as 96.6% to 90.8% in year 2024 and 2023 respectively. The last two will be the CASA ratio. CASA ratio also mentioned the current account and the saving account ratio is the proportion of the bank deposit. So from here, public bank and RHB Bank stand a more same volume, while RHB Bank will be slightly higher than public bank in financial year 2024. So, but in terms of the funding and liquidity risk, the RHB Bank have the lower risk compared to public bank. The last will be the market concentration. So actually, after we analyze, so the public bank risk trend will be in more conservative compared to RHB with more higher risk, as the interest rate sensitivity for RHB will be more volatile, as well as for the public bank will be more stable. So conclusively, the risk for the public bank is no lower compared to RHB Bank. I think that's all from me, Don Chairman. So we go to the next one.
Okay, good afternoon. Building on the previous analysis, I will present WACC and EVA and highlight the key takeaway for our decision. A bank creates value when ROE exceeds the cost of equity KE. We compare ROE versus KE for consistency. KE equals 10% for both banks. Value is created only when ROE is greater than KE. Public bank ROE is 12.8%. RHB is 9.9%. Spread to 10%. PBB plus 2.8 pp. RHB minus 0.0. RHB minus 0.1 pp. EVA equals ROE minus KE times average equity. PBB average equity RM 56.0 billion, spread plus 2.8%. EVA about RM 1.57 billion. RHB average equity RM 31.7 billion, spread minus 0.11%. EVA about negative RM 0.03 billion, essentially zero. LDR PBB 96.6 to 97.9, RHB 90.8 to 95.3, both blue 100% balance fountain. CET 1 PBB 14.3, 14.7, RHB 16.44, 16.667, GLL PBB 0.52, 0.59, RHB 1.47, 1.74, LCR average 133.4 at PBB, LCR and NSFR above 100 at RHB. Public Bank holder RHB, if KE equals 11%, the car is unchanged PBB plus 1.8 pp, RHB minus 1.1 pp. Okay, thank you.
All right. Okay. Before I start my things here, I want to thank you to the young team, where you have done the hard work to dig all the soil to see the roots of the tree. I do appreciate it. And in business, I always believe that never sell a ship that have a leak inside. So to make sure in business, we put more rice in the bowl than what we take out. So I have listened to your discussion. I reviewed the data on you have presented from Public Bank versus the RHB Bank. So now I will be delivering the final decision now. So our mandate in this meeting is very simple. We just want to see the economic profit. So we have the cost at 10%, which is the minimum return that we demand for all the risks that we have taken. On one hand, we have Public Bank. Okay, Public Bank, the report shows that they are earning 12.8%. When you subtract to our cost, which is the 10%, you get 2.8% of surplus. So the 2.8% of surplus already means how much just now? If I'm not mistaken, from sharing this now is more than $1 billion in true profit. This is what I call as a strong business. So because why? Because it respects the shareholders' capital. But for RHB, they are good people, they are hardworking one. But we look at the results. What they give us, they are earning 9.9%. Barely match our cost. Our cost, how much is 10%. So you subtract it, there is no surplus inside. So the economic values is equal to 0. So in this type of thing, I see there is no growth in the middle. And we go to the risk, because risk is very important here. I listened from Bryan just now, if I'm not mistaken. To keep money is very hard. Public Bank is very careful. Why? Because their bad loans is only 0.52%. This shows that Public Bank is very disciplined. They check the credit, they know the customer, they do very good. And RHB, I'm not saying they are very bad, but they have a bad loans of 1.47%. This almost 3 times higher than Public Bank. So in this case, I can say like it's, if you know there's a leak in the ship, why are you going to sell the ship? So I of course I prefer the ship with fewer leaks, the Public Bank. So the final decision, after I look at all the evidence provided, so we will move in steady hands. The decision is, first, Public Bank, we will buy it. We will accumulate the shares there. It is safe and it is profitable. They run with integrity. For the chairman, for the boards, it allows us to sleep well at night. We don't afraid that our money will gone. But for RHB, I don't want to sell first. We don't want to sell. We will hold. We will not sell. Because they are actually stable and have a strong capital. But we will not add more money inside. We have limited as well. So we will wait. Let them prove until they can tighten the ship. Let them, when their income is more than 10%, then we will improve the harvest. We will going to put inside it. Okay. Before I close this meeting today, to the investment team, I want them to do as fast as possible to improve the rebalancing immediately. Don't just price with patience. As for your team, you have done a very excellent job today. Very excellent. You have clear eyes. You look at the fundamentals. You look at it, you present to it. Most people just give me spreadsheet and tables. They don't talk about this. So you're doing a very good job. So if there is no any question into this meeting today, the meeting will be adjourned. And thank you for your time. I appreciate that. Thank you.
Okay. Thank you, Tan Chairman. Thank you, Chairman.
Thank you.
Bye bye.
Thank you,
Bye.
Chairman.